Welcome back, everyone. Recently, I've been doing some thinking about some potential strong bear cases for uranium, and this has led me down one path that a line of thought, basically. And so today, in this video, I'm going to discuss a trade idea that I've been thinking about to hedge out the risk of that bear thesis. Now, this video especially is more not technical, but more difficult to implement than some of the other things. So it might not be interesting to you, although I think the idea is something I'm thinking about and would love to hear different input on this idea. So let's get to it. So the basic premise for this trade idea is there a way to hedge out the primary risks of the uranium bull thesis being incorrect or underwhelming to some extent, um, while having the hedge be done in a way that wouldn't negatively impact the performance, at least to a great degree, if the bull thesis in uranium is correct, and in a way where if both sides go wrong, the possibility of that and the likelihood of that sustaining is very low. So here's my idea. So the trade is long physical uranium, doesn't have to be physical, but basically long the uranium bull thesis with a hedge by shorting the Kazakh Tenge. And I'll get into why this is done in a second. So the uranium bull thesis is basically that mining uranium is not economic at these prices. So what is the most likely way that this becomes incorrect is if someone or everyone could lower their costs of mining. Now, what entity could possibly be big enough that if their costs were to drop significantly, that they'd be able to impact the thesis? Well, my primary conclusion in that is, well, Canada's, I suppose, but there's many degrees there. But the simplest one is Kazakhstan. And because they're the closest in some ways, and there's a number of factors. And those who understand uranium enough to be thinking about this probably might have had a similar thought. Um, but the point is, what would allow them to ramp up production at this uranium price? Well, if their currency were to fall dramatically and their costs were to fall with it, and yes, I know there's imports of chemicals and stuff, and there's a number of factors, but I'm just saying, wouldn't there's a whole bunch of people that are talking about a falling uh, EM or Kazakh Tenge as allowing them to produce more. So here we are. So can the value of the Kazakh Tenge go down while uranium goes up? I would say yes, and I would say that that to some degree is my base case most likely scenario at this point, at least for starting the thesis, in my view. Now, can they both be wrong? Well, of course they can both be wrong, but let's look at what happens in this scenario. This would mean that Kazatomprom's costs are rising while their selling price shrinks. Now, the other way to go about this trade, some might say, is being long Kazatomprom. I prefer it this way, even though it's more complex, but the point is, in this scenario, you wouldn't want to be an equity holder of Kazatomprom because even if you think they're making a significant amount of money now, and even if there's a number, or even if you were to say that much of that uranium's delivered into contracts at higher prices, well, you still have rising costs and you still have potential downward pressure on the future expectations of uranium or what have you. But basically, they would be bleeding while waiting for the utilities to stop underbuying their consumption at this time, they'd be trying all they could, trying to renegotiate the subsoil use agreements, trying to shut down production even further, if they're not already. So there's plenty on the uranium bull thesis out there, and I've talked about it a lot, and other people have talked about it even more. But with the added Tenge short, a few things that you're hedged against are strong US dollar, and that includes like a flight to quality type scenario, uh, deflationary or even recessionary fears to some degree, an EM currency crisis, which would be the potential for falling costs in Kazatomprom. And if there's the big winner in this scenario, if you wanted to get super bullish, which I generally don't, but the big winner that you're hedged against is a Venezuela-style crisis in Kazakhstan, because that would probably be a big winner on both sides of the trade. Now, those observant of you who were watching earlier probably saw a little asterisk next to Kazakhstan, and that's because I believe there's a decent margin of safety with falling costs before Kazatomprom is happy with the current profitability, let alone begins to ramp up production even more. And I know also that Kazatomprom has stated that their production will remain steady for the next 2 years and won't be adding much to capex for the next while anyway. So this is mainly a hedge against if things change significantly enough for that to change also. And at the same time, I also know that the thesis and question the degree to which Kazatomprom can ramp up the production to the levels of the subsoil use agreements, let alone the flex up scenario, which would involve producing 20% more than that. So, and also I question why they would do that at the bottom of the cycle, just to gain market share, but we're talking hedges here. So as always, this is never financial advice. This is just some of my thoughts, and I would also appreciate many of your thoughts. If you have any input or thoughts on the potential for this trade and what you like or what you hate or what would concern you about the scenario, I'd love to hear it, because there are far more of you and you expertise probably in a whole range of things than me. Well, there's one of me. There's what now, 400 of you? Wow. And thanks again to the 400 plus of you who have subscribed to this channel. I really appreciate all the feedback, back and forth, comments and thoughts. So y'all are great. Keep it up. And I hope you enjoyed or hope today's was thought provoking, and I will catch you next time.